I think probably first question to Robert Parker. How does Credit Suisse basically see in 2015 the global market? Where are the big risks?
I think the big risks are monetary. If we look, for example, at the American Federal Reserve, they have increased their balance sheet to $4.4 trillion US dollars from $800 billion US dollars at the time of Lehman Brothers going bust nearly 7 years ago.
Ran the printer pretty hard then.
They've injected $3.6 trillion US dollars into the US dollar money market. So risk number one, actually, I don't think is whether the Federal Reserve raises interest rates or not. The risk is, do they start to shrink their balance sheet and take liquidity out of the system? A correlated risk is the European Central Bank have said very clearly they're going to increase their balance sheet from 2 trillion euros to 3 trillion euros by September 2016. What happens if later in this year Mario Draghi makes a speech saying actually the Eurozone economy is doing very well, and by the way it is starting to accelerate, and therefore we don't need to do more quantitative easing. So I actually think that liquidity issue is absolutely critical, and there is a very clear correlation between the extent of global liquidity, which of course at the moment is abundant, and global markets. And if you start to take liquidity off the table, that actually sends a very negative signal to global equity markets and, for that matter, global credit markets.
And meantime, we've got markets where already in equity markets, asset values have been pushed pretty hard, and there's a scramble for yield.
Correct.
That inevitably is going to take a whacking anyway, given that U.S. rates must rise at some point during the year.
Correct.
How significant is that? Are we seeing a bigger? Is that going to be a bigger issue than what you were talking about?
I think in terms of the outlook for interest rates, the picture actually is very clear, which is that in Europe and Japan we will have official rates near zero for at least the next 2 years. In America, I think it's also reasonably clear, which is that interest rates are going to go up, but the pace is going to be very slow, and actually the magnitude, the quantum of the increase is going to be very small. So I think that this time next year, let's say the middle of 2016, it's reasonable to forecast that the federal funds rate will be 75 basis points compared with 25 basis points now. I think as we go into 2017, I think there's a chance that they actually may increase or accelerate the pace of interest rate increases, because then I think we will move from a very low inflation environment to a slightly higher inflation environment, but that's 2 years down the road. And in 2 years' time, 3 years' time, we could see American interest rates at perhaps 2.5%. Now that pace, that very slow pace of American interest rate increases, I think will lead actually to markets, the upside being capped, but I don't think it's going to lead to another major market correction or a crash. And if you look at the circumstances today relative to when we have had similar crashes like 2000, like 2008, the circumstances today are totally different.
Can we just sort of dwell on this point about yield? And if I throw it over to David
Yes.
Murray here, there has been discussion. We're in an environment of very low interest rates, and people seeking return, reasonable return, are being pushed into riskier areas. And is this a risk factor in the economy here and the markets here?
Well, it adds to this risk people are concerned about in the equities markets. But when you look at the decisions people are making, they're entirely rational given the monetary policy settings that we've just talked about. So the issue is whether they have, depending upon their investment circumstances, the capacity to remain patient enough to see through any adjustments in the equity market. If they have, and they take yield out of solid consumer staple type companies or other solid companies in the market, take good dividends from those, then those decisions are entirely rational.
There, in other asset classes, there's maybe it's people looking for a shorter term returns and entering into areas where perhaps traditionally they're not used to. higher risk bonds, for example, some property, for example, that this low yield environment, that's encouraging that?
Well, the real issue, I think, is where pension funds in particular go for fixed interest returns. A rational investor, once again, in the current environment, might keep shorter than they would traditionally, particularly when they look at the potential outlook for sovereign bonds around the world. But in Australia, we don't have a very deep corporate bond market, and so the decisions around holding fixed interest securities are somewhat skewed by this environment.
I saw, David, you were nodding over there in terms of you agree that that's an area of potential risk?
Yeah, I mean, I think what's happened is, as David mentioned, government bonds globally are just not attractive. The prospect of lending to the German government for 10 years at 60, 70 basis points doesn't seem to make a lot of sense to us. And you can move a little bit further down the credit risk spectrum to pick up yield, but then the spreads have come in a lot as well. The problem locally, as David said, is there's not a lot out there beyond the government and semi-government bonds for local investors. And then people move into things like hybrids, thinking they're a fixed income investment when there's a lot of equity risk behind that potentially that probably they're not getting rewarded for.
And there's and Robert, if I was an investor in Europe, a pension fund looking at a German government bonds, in some cases negative returns. How do I sort of?
Well, I think first of all, let me just report on a conversation I had at the European Central Bank towards the end of last year when they were announcing quantitative easing, and obviously they started quantitative easing in March this year. And the discussion was very clear from the European Central Bank, which is that they want to depress government bond yields because they want to force or encourage investors into what they define as riskier assets. So whether that's equities, whether that's lending to small and mid-cap companies. But they took the view, and I think correctly so, that to provide the necessary stimulus to get the European economy moving again, and let's be blunt, we've been through 5 years of one crisis after another, and through those series of Eurozone crises, we have had a very unsatisfactory growth rate with very high unemployment. And the view taken by the policymakers in Europe has been that with the European economy needs stimulus, it needs kick-starting, and one way to do that is to encourage very high levels of surplus investor cash, because investors are very defensively positioned, to encourage more risk-taking. And arguably, that's exactly what is happening. Now, should we worry about that? And I would argue it's too early to worry about it, because we're moving from a situation where investors are super conservative. They've been taking very little risk indeed. Are we moving into a situation where investors are taking too much risk? Do we have bubbles in markets around the world? The answer is no, we don't. Now, we may have a different conversation in 2 or 3 years' time, but certainly today, investors are moving from that very defensive position, very slightly taking more risk. So I don't think you should be too concerned about it.
Edward, what are investors here asking for, and what are they looking out for?
Well, I think a number of things. David may want to obviously add comment because, of course, a lot of our work in terms of advice towards our clients comes, in fact, from both David and for the likes of colleagues of Roberts. Essentially, it is accessing global markets. Australia is one small market. I think it's 2% of the global capitalisation of the world.
Less,
And concentrated.
Highly concentrated in banks and mining. Notwithstanding, obviously, the fact that we have a bias towards our own country for tax reasons and other things. Nevertheless, the ability to access global markets is extremely important, particularly in this environment.
Could I pop up and talk commodities, which is all related? He says carefully choosing a topic that's bound to have ramifications everywhere. I mean, the two commodities that exercise people in Australia are iron ore and oil. Now, Robert, you've spent I think you've just been in Saudi Arabia, so you're probably better equipped to talk about what's going to be happening with the oil price than the rest of us. And if you wouldn't mind talking a bit about that and any relevant comment you might have on iron ore.
I think what's happening in the oil market at the moment is fascinating because it's unprecedented. And the reason why I say it's unprecedented is because we have now the advent of the shale industry as a threat to the traditional energy market, which of course is dominated by Saudi Arabia. And over the past year, and most notably in the second half of last year, we had this fight for market share between Saudi Arabia and the other major Gulf producers and the shale industry. Now, what's interesting about the oil market is the speed with which the shale industry can cut back on production, or when prices rise, increase production again. And that is unprecedented, because if you look at the conventional oil industry, let's say we're developing offshore oil fields or even onshore, it takes many years to develop a new field. With the shale industry, the economics of the shale industry is such that they can actually develop new fields very quickly indeed, certainly 6 months, less than 1 year. Now that means we've got some natural stabilizers in the oil market, because if the oil price goes back, let's say if we look at North Sea Brent as a benchmark, if the oil price goes back to $70 to $80, that immediately improves the economics of shale, and production will come online. Likewise, if the oil price goes down to $40 per barrel, the shale industry economics get destroyed quite badly, and production, as we have seen in recent months, stops, and therefore we've got a natural floor on the oil price. So I think we're now stuck in a range of really sort of 40 to 80 if we look at Brent. And to fine-tune that forecast, one could probably squeeze it in a little bit to say there's a floor of really 50 and an upside of 75. And I think that's actually good for the global economy, because less volatile energy prices actually mean that economies can have actually a much higher degree of certainty.
Certainly, most users of oil would be pretty comfortable at those
Well,
prices.
this is also, if you compare oil prices today with where we were a year ago, Brent peaked at close to $120 per barrel. This is a huge boost for consumers worldwide, and a huge boost for countries such as Europe, such as Japan, such as India, and for that matter China, who are consumers of energy. It's not good news for the exporters of energy.
Right.
So you've got a very clear list of winners and losers here.
That's right. Well, I mean, there's all sorts of peripheral beneficiaries, such as inbound tourism to Australia.
Absolutely.
Of course, that's currency related as well. But what I think you're saying really is that oil, that the price of oil is somewhat more controllable by the natural market.
Correct.
Than the price of iron ore, because the problem we seem to be having here is that Australia is not the only large producer of iron ore. I mean, the biggest single producer of iron ore in the world is Vale in Brazil. The two next biggest ones, which are actually bigger than Vale, are BHP and Rio in Australia. And there's a fair degree of discomfort in Australia at the moment about whether or not the government should become involved in investigating whether something should be done to shore up the price of iron ore. The government's decided not to.
Well, if I could just interject there, governments which intervene in commodity markets typically fail. So I think probably your government here in Australia has made a good decision by deciding not to intervene. And the world is littered with governments losing money on intervention in commodity markets.
I'd invite David Murray on that point as well, on the iron ore inquiry.
Well, it's not clear to me where the market failure would have been to justify intervention. Typically, intervention can be justified where markets become monopolised. But people trying to a monopolist does not increase production when prices are low.
Yeah.
A monopolist holds production. So people increasing production because they can still make a marginal return is not indicative of market failure. And therefore the case for intervention seems to be absent.
I think the thing is, as Robert mentioned as well, compared to shale, iron ore projects are huge. I mean, some of them are literally billions of dollars and years in planning. So it took a while, I think, to get capacity up to meet the demand that they realised was coming from China, and then reacting to the fact that prices are maybe lower than they'd hoped for, and changing plans will probably take a bit of time as well.
And so this is markets working as markets work.
Indeed.
I would also add that one has to look at your key competitor in the iron ore market, that is to say Brazil, and emphasise the Brazilian economy over the last 2 years has been under extreme pressure. And to give you an example, the Brazilian GDP growth this year will probably contract by 1%, and unemployment is rising, consumption is under pressure. Clearly they've got a problem coming back to the oil market with corporate governance and fraud at Petrobras. So, if you compare Australia with Brazil, you're comparing yourself with a reasonably comfortable economic situation with at least good, reasonable, positive growth this year, with your key competitor, which is a very stressed competitor.
There was
So you have to look at the behaviour of Brazil in that context.
Yes, it doesn't sound like they've got much room to move.
No.
Well, actually, just on the emerging economies, and several years ago, a term that was in vogue was the BRIC economies. But you think of all these, Brazil, Russia, India, and China, going through, it seems, growing pains. They are no longer the power. Well, they're powerhouses, obviously, but the rate of growth doesn't seem to be as what we initially thought they would be.
I was never a fan of the phrase BRICS, which, with the risk of being cynical, I always regarded as a marketing gimmick. And if we look at the situation for 2015, the Brazilian economy will contract by 1%. The Russian economy will contract by at least 4%. There's a huge problem with Western credit lines being cut to Russian companies and to Russian banks. And that's aside from sanctions and the fall in the oil prices having a negative effect on the Russian economy. In contrast, India, the growth rate is accelerating. I think it's reasonable to forecast that Indian growth will be 7 to 7.5% this year. Inflation is falling. They're a big beneficiary of falling commodity prices. And I think this new government is tentatively moving in the right direction in India in terms of encouraging foreign investment. In case of China, yes, the economy is slowing down, but we don't really have a problem in China. We're not going back to 10% growth, but I think they could easily hold 7% growth this year. So we've got this big divergence between emerging economies, between those that have got huge structural problems like Brazil, geopolitical problems like Russia, but the Asian outlook, which is very relevant to Australia, actually is generally very positive.
Robert, what do you make of the concern that we have in Australia about China, that they're no longer building railroads and very iron, very steel-centered and housing? Because there's somewhat of a glut, or certainly a misallocation of housing around China, and that they're moving from that sort of development to making widgets for domestic consumption. And there's a concern we've got that widgets use a lot less iron ore.
I'm not quite sure how much iron ore goes into widgets, but assuming it's very little in.
Iron ore light ones.
I think the Chinese, what's happening in the Chinese economy, I think, is absolutely crystal clear, which is they are concerned about deflation. That means that the monetary policy in China will be very easy. They've cut bank reserve requirements, they're cutting interest rates. That is a major factor in fueling the Chinese equity market, and we have been positive on the outlook for the Chinese equity market now really for about the last year, and we remain positive on the Chinese equity market. So I think that loops back into a positive outlook for the Chinese economy. I think strategy is boost consumption. Linked into that is a recognition that wages need to go up. And if you look at wage acceleration, it's very powerful in China, and that's deliberate policy. In addition, to boost infrastructure, to offset what you've referred to, which is the slowdown in the real estate market, and that they are very carefully trying to deflate what was clearly 18 months ago a bubble in the real estate market. Now, it's a challenge from a policy point of view of deflating a bubble. Most bubbles, as we all know, burst, but so far they're actually successfully lowering down that problem in the real estate market.
There are three moving parts for the Australian economy. There's the rate of growth in China generally. There's the extent to which that growth in China is tilted towards demand for iron ore, because that was the shape of the growth. But the most important one to consider from now on is for every percentage point change in the mix of growth from investment to consumption, there is lower demand for Australian economies.
I mean, there are opportunities for Australia in other areas, but clearly not as iron ore is by far our biggest export, and that's the one that's probably not going to grow very much. Tourism, education, things like that are all growth markets as China becomes wealthier, but you know, we've got many competitors in those areas.
So that sounds like we should rotate into agricultural exports and make it. I mean, it's quite hard, certainly in Australia, I find, to be able to do much with agricultural exports, because so many of the industries are very mum and dad. But I would assume that if Chinese companies want to come into Australia and invest in agricultural enterprises, that's going to be a positive for them and for us, you know, within reasonable limits. Edward, you got a view on that?
No, well, look, I mean, I think that's absolutely right. It's just that it is very hard to go from an industry that's run by 3 or 4 very large players into a very disaggregated sector of the community, which is agriculture. You know, big business has never been particularly successful, I don't think, or has a reputation for being necessarily successful in agriculture on a scale that would make a difference, I guess. But those are sorts of things definitely that will be more and more important for Australia. We would certainly have that view.
So, I mean, sorry, I was going to say, I think it was not long ago that Sydney Airport were pointing out that this year they think Chinese visitors will overtake New Zealanders for the first time as the most people coming through the airport. So, you know, it is happening. They're all smaller things.
Perhaps a separate topic, but agriculture needs a dedicated policy work. We don't think of agriculture as having R&D in it, but it actually does a lot of R&D. You know, the type of grass that you grow, the breeding stock, you know, the bloodlines in breeding stock. It has an awful lot, but the structure of the industry, the investment in water reticulation, and the fact that the industry is structured at the moment to only be able to afford very low paid farm workers in the Australian context means that there is a structural problem. And if that can be resolved, then there's quite a lot of additional production can be done.
I think on the other side of that also, the capital side is, capital has been very reluctant partners with agribusiness, evaluated agribusiness, particularly around the boom and bust cycle that it runs through. I'll just put that out to the fore there. Is that something that you're seeing?
Well, it's been the same in banking. It's a very volatile business, and it can only tolerate very low levels of financial gearing in agriculture. Now, many countries have policies which ensure through the cycle and take some of that volatility away, which creates much more stable investment environment. But that needs to be accompanied with other things that improve productivity.
David, it's been suggested that I was talking to an American pension fund, and they were saying that they like to actually buy agricultural land and lease it to operators.
Yes.
And I think that's the only shortcoming I can see in that is the tie that so many farmers in Australia have to the land they're on. But I would have thought that, economically speaking, it's a good idea.
Well, I think you raised an interesting point, which is that we discussed how to manage investment programs, whether for pension funds, for life insurance companies, or individual investors in this low yield environment. And actually, one thing that we are clearly seeing, notably in the pension fund industry, is asset class diversification into areas which they have traditionally not invested in. And one area actually has been to go out and buy agricultural land and actually lease it to farmers, exactly what you've just described. And the yields on that are actually much more successful than if I'm going out and buying your German government bonds yielding only 60 basis points. So we're seeing this asset diversification. I think that trend also into what can be described as illiquid assets. Because if I buy agricultural land, it's I can't buy it today and sell it tomorrow. It is I'm there for the long term. But that longer term illiquid asset allocation is certainly going to increase. And that is one way that many pension funds, superannuation funds, are going to deal with this low interest rate environment.
The
And by the way, I think that would be good for the agricultural industry here in Australia.
yeah, but black soil acreage on the Liverpool Plain in New South Wales sells for around high twos, $3,000 an acre. The equivalent in the United States is $7,000 or $8,000 an acre.
That's interesting.
So it's a very undeveloped area of investment.
Huge
Except
potential.
that the Liverpool Plains is a very special, and it's a very special piece of land. And we do suffer terribly from weather volatility, which
Yes.
is not necessarily the case in other countries. That record does make the mission of agriculture harder.
Yeah, well, the US does have that insurance system,
So, yep.
which costs Uncle Sam about 12 billion years.
Yes.
Yes, and one has to challenge whether that's money well spent.
Spent.
Yeah.
Yeah.
But I think the overall theme is that, to answer your question on this low interest rate environment, we are seeing greater diversification into areas such as agricultural land.
And infrastructure.
And infrastructure. We're seeing very strong demand for infrastructure assets worldwide at the moment. And the yields are today very attractive relative to government bond yields. And if you like, they are quasi-fixed income. They've got the same characteristics of a lot of fixed income markets.
Well, if you look at the university, the larger US endowments, where it's in perpetuity, substantial investments are in exactly that. It's in
Yes.
forests.
Yeah.
And they've been doing this now for some time. Exactly the reasons that you
But
mentioned.
basically, we always think of illiquid assets as real estate, private equity, infrastructure, but now there are a whole range of other asset classes which are developing, whether it's insurance product, whether it's agricultural land, as we discussed, whether it is leasing, whether it is asset managers buying bank loans from banks which are deleveraging. So that broad illiquid asset class diversification, I think, is a very strong theme.
We can't get a couple of people around a table in Sydney without talking about property. It's pretty much a given. But in a recent weekend, particularly around investment property in Australia, we're starting to see a lot of activity in energy. In a recent weekend, there was more than $500 million sold in one weekend in terms of an apartment tower, sold out in 6 hours, which is a remarkable figure, the development there. We're starting to see some of the banks here in Australia react to investment property. Just what would the view, David, I'll throw it over to you, what would the view about investment property and that as an asset class?
Okay, I think there's two things in there really. I mean, one, the banks perhaps are reacting more to APRA and capital requirements and things like that, as much as perhaps their own concerns about the property market. So that's maybe a separate matter. But I mean, property in Sydney is expensive, but we were talking earlier today, someone said the property in London, in Manhattan, in Hong Kong is expensive as well, and in a sense Sydney is one of those global cities, so it probably always has been expensive and always will be. Interest rates, we've had 2 rate cuts so far this year. That obviously helps keep things chugging along, and that's been obviously one of the things the RBA thinks about when they do cut rates. They want to boost the rest of the economy, but they don't particularly want to boost the Sydney property market. But the two, you can't really separate the two very easily, although our New Zealand friends have tried to do that recently in Auckland.
Minimum 30% deposit.
And there's obviously, in the case you talked about, it's probably a prime example, there's obviously a lot of money coming from offshore, particularly into some of those off-the-plan type developments and so on, and I would imagine there's quite a bit of money still to come behind that. So, I mean, as long as the economy is chugging along okay, unemployment's quite reasonable in Australia and rates are low, it's very supportive. It doesn't mean the property market will keep going up, but there's not sort of any obvious factors out there to see it come crashing down in the short term.
There is also a geopolitical dimension here. We see this, in what I would define as geopolitically safe cities or countries, of which obviously Australia is one. But for example, living in London, every time there is a geopolitical risk problem somewhere else in the world, whether it's in the Middle East, whether it's in Russia, whether it's all the problems in Greece, we see another wave of foreign money coming in, and whether it's American cities, Australian cities, or some of the top European cities, such as London, We are seeing very strong capital inflows driven by people's fear of investing in their home countries.
David Murray, more broadly, risks. What are some of the speed humps looking out into the economy?
Well, I think the policy issue is with the reduction of investment in Australia, with the end of the mining investment phase, will we have converted into new productive investment with policies that drive higher productivity, or will we have participated in asset momentum in housing and equities without highly productive new investment? Being capital dependent on the rest of the world, it's important that we're more careful with investment and that we make it as productive as possible. So I see an issue with housing because there's so much momentum there. On Sydney, Robert's quite right. Sydney is also heavily differentiated now from Brisbane and Melbourne because the New South Wales government has got a mandate to recycle old assets into productive new assets. So Sydney's going to have some additional momentum as a consequence. In the equity market, that's the same as the problem globally. Is that can that momentum be managed? That people are making rational decisions, but can it be managed? So the only Robert's addressed the monetary issue. India, I think, is a bit of a sleeping giant for us, positive. And the other biggest disruptor is the digital world. And that'll have very profound implications for a long time yet. And we'll have to get used to seeing great company names that we've got to know and love potentially disappearing from disruptive new technologies.
Or reinvent themselves.
Well, there's not a lot of evidence around. My policy always was turn and attack, but it's not that common. And I think an established company has got to use the power of its brand and combine it very aggressively with digital technology if they're going to see off some of these new models. And that typically doesn't happen.
Gentlemen, I've just noticed the time. I think we should probably go on all day actually, because there's suddenly all these topics one wants to have a rush at. But thank you. I think we're probably better wind it up now. On behalf of Eric and myself, and thank you very much for turning up and offering us the space for this conversation. I'd just like to say thank you to everybody for taking part.
Thank you.
Thank you.
Thank you.